Welcome. This is an illustration of cash flows in various stages of procurement and production, as well as receipt of accounts receivable. So just to start off with the idea, here is what happened. In period 1, we procured inventories worth $100 using credit. In period 2, we made 10 coffees, each coffee using $1 of inventories. In period 3, we sell those 10 coffees costing $10 for $25 on credit. In period 4, we pay down our payables that we had for purchase of inventories. In period 5, we receive cash against accounts receivable. Now let's merge that concept with this formula here. Cash flow is any sales we've made minus cost of goods sold, minus change in inventories, minus change in accounts receivable, plus change in accounts payable. We're going to use that concept to build this table using these ideas here. So let's go to Excel. In period 1, we didn't do anything. We just had cash in period 0, sorry. In period 1, now first thing is to build that equation into Excel, which means it's going to be plus sales, that is plus C2, minus accounts receivable, change in account, not accounts receivable, but minus change in accounts receivable, plus change in accounts payable, which is 0 right now, minus cost of goods sold, which is also 0 right now, and minus change in inventory. Okay, in period 1, we did not make any sales. Our accounts receivable, we procured inventory using credit. So our accounts receivable went up, accounts payable went up by $100. Our cost of goods sold did not change because we didn't make any sales. And our inventories went up by $100. So the net effect on cash is 0 because it is plus C4 plus the change in accounts payable minus the change in inventories. Essentially, we didn't spend any money to get the inventories. You could think of getting the inventories without paying cash, but it's on credit. Okay, let's go to period 2. We simply make 10 coffees. So there's just a reshuffling going on between raw material and finished goods. No sales yet, no change in accounts receivable, no change in accounts payable. Since there is no sales, we don't have any cost of goods sold. And no change in inventories on a whole. However, we have manufactured finished goods from raw materials. So that's how we get the 200. Okay, go to period 3. We sell those 10 coffees costing $10 for $25 on credit. Okay, so sales, yes. But this sales is on credit, so that will mean our accounts receivable also go up. Accounts payable haven't changed. We haven't made any creditor payments yet. But these coffees were $25, cost us $10. And our inventory has gone down by $10. So again, there is no change in cash flow. Even though this is an income statement item, sales is 25, cost of goods sold is 10. So essentially it says our profit should be $15. So we do have an income statement item, but we don't have a cash flow item. Moving on, period 4. We pay down payables worth $50. Okay, no sales, no accounts receivable, but payables go down by 50. And no cost of goods sold because there's no sales, no change in inventories yet. So now our net cash flow is down by $50 to $150. In the last period, we receive cash against accounts receivable. So our accounts receivable go down because somebody has paid off their loan to us. So our cash goes up and the rest of it is all 0. So our net cash flow, or this is not calculation, but this is cash flow, cash position. That is a more appropriate word. So as soon as we get those $25, our cash position goes up by 25 from $150 to $175. And that's exactly what is given in this table right here. So 200, 200, 200, 200, 150, 175. So like that right there. And that is table 3.14. Thank you for listening.